Good day, fellow investors. Exor Stock offers a very interesting situation. The market cap is 15 billion euros, but the gross asset value is 40 billion euros. When we deduct the debt of 4 billion, that's 36 billion compared to the market cap of 15 billion for a huge holding discount. And the company owns these interesting businesses: Ferrari, CNH, Philips, Stellantis, other smaller companies like Iveco, private companies. So let's analyze these to see whether there is value in the holding company or in the specific stocks discussed. Before we start, just a note here, this is what I do. I look at businesses and I try to find businesses that offer low risk, high reward situations, and that is the essence of value investing. If you want to increase the value, the lower risk, high reward of your portfolio for long-term investing, check my research platform in the link in the description below. Now, let's immediately start with Ferrari race, also traded in the States, market cap 70 billion, P ratio almost 40, very small dividend yield. The company Exor owns 19.5% of the economic rights alongside higher voting rights, but the economic rights are the key for our retail investor perspective. That value for Ferrari is 13.5 billion. Compare that to the market cap, so practically you are buying Ferrari, the cash that is there, and the rest is for free if you buy Exor. However, Ferrari stock is also a little bit in a downturn. Ferrari shares sink by most since 2016 on cautious forecast. They had this investor day and they gave 2030 guidance, and it was not really some stellar guidance. Slow growth expected ahead, a little bit of growth in earnings per share, cumulated free cash flow, industrial free cash flow, also when you divide it by 5 years, is 1.5, 1 point something billion per year, which even in the best case of situations in 2030, the P ratio would be exactly from 40 to 30. And in that case, you say, okay, Ferrari, the brand, the everything. However, the value of a brand is how much cash it can deliver to your bank account. And that is the essence also of investing. If there is a high valuation, which means the real business yield is low, at best, Ferrari, given the guidance, which is always what happens in the best case management scenario, is at best a flat. The real value from a business perspective is half where it is now, a P ratio of 20, so a little bit higher dividend yield, 4-5% cash flow yields. Still, let's say, overvalued from a value investing perspective, but let's say that would make it fairly valued. If we bring from overvalued now down to fairly valued, the stake in Ferrari is 7 billion euros for Exor. We were at 36, we are now at 29 billion, but still a lot compared to the 15 billion market capitalization. Now, a company that we discussed often on this channel, CNH Industrial, 3 billion stake there. The P ratio is 14 on weakness in the agricultural sectors. Farmers are not buying these heavy combines now because of tariffs uncertainties, because of the great 2021-2022 years, and now we have to wait for this inventory to get sold, reduced down, and that is how the environment looks now. But when it comes to these cyclicals, always keep in mind, the best time to buy a cyclical is when things look ugly, not when things look great. So now, if we're looking at this with the stock price decline, it for sure looks ugly. And the business is still there, revenues are down a little bit, profits are even lower as they are reducing inventory, but they are also investing, new launches, new businesses, always ahead competing with the few competitors there, but they have the sales, they have the market share. Think they are stable there, also a little bit increasing, but we have to survive the bad times that are counter to the great times the company has had just a few years ago. However, if you look at things now, then it is not that great, but the stock is as cheap as it gets. Delinquencies, commercial real estate here also going up a little bit, so that is also an issue there. However, they are doing their business. Balance sheet looks okay, a little bit stretched, but okay. They're looking for, again, M&A. Perhaps if you do an M&A when things are bad, that's better. I don't know if they have the power to do that, but they could perhaps if just the situation improves a little bit, and they are famous for dividends and share buybacks. They have given the guidance for this market, and you can see here 30% down. The combines, there was expected to already see some improvements in South America this quarter. It didn't happen. APAC also down significantly. Revenues down, margins destruction, and that means that from making good money, we are going to, okay, this is still the first part of the year, but let's say not making any money. From a valuation perspective, if they go to earnings of $0.50, the market doesn't like it, P ratio of 10, that's a price of just 5, which is ridiculously low, but that would be an absolute bargain. So now we are already, let's say, at cyclical bottoms. These guys can deliver 15% free cash flow yield in good times, and usually these cycles last 2 bad years, 3 bad years, to good years in agriculture and food. We are not yet seeing the uptrend in the agricultural sector, but this is one to watch closely. I was looking a little bit at data. Farm income down here, expected a little bit higher here on inflation, but also costs are going higher, but also inflation means costs going higher, so that is also something there. And if we look at the conference call from the CEO, global industry retail demand is expected to be down around 10% from the year, and that is what you can call a recession in the industry. So when it comes to this cycle, it's not just food prices, it's also interest rates. When you're looking at that new beautiful tractor, what is the monthly payment? Will there be a rebound in 26 is the key question. In the meantime, you can see here the potential the company has, 2 billion in net income compared to the current market cap. That's a P ratio of 6. So 5, 6 is usually the cyclical bottoms of these agricultural commodity businesses. However, we are now here, let's say ugly, if you value based on this, but I would say 1.5 billion, the average free cash flow that they can make. There is significant debt, 4 billion, which weighs on the situation. In good times, they'll make 2, in bad times, they'll make 0. On average, they should make 1 to 1.5 billion. And that is already, let's say, a 10% yield, perhaps not spectacular, but long term, maybe you can play these cycles a little bit, see how this fits your portfolio. For me, I'll be watching it. Here I have it on the quadrant, 10% still expected. Perhaps given as the situation is going down, I have to push it to 12%, but I want to see it here somewhere about 12 to 15% to really be something that I consider. So I'll keep on watching it here on the value investment quadrant. Of course, in the short term, if Latin America rebounds, trade gets resolved, tariffs get resolved, this can rebound even quickly, but that is the risk and the reward of waiting for these things. So check my value investment quadrant recent update here in the card if you're interested in seeing stock by stock that quadrant that I just showed. The next company, Stellantis, 4 billion value there. I recently made a video how as the stock of Stellantis is going lower, it looks more interesting because of the lower price. I thought we were value investing, looking for bargains, but I was destroyed in the comments how now Stellantis is a terrible company. However, from a risk and reward, it is, yes, risky as all other automotives are, especially as I'm seeing more and more Chinese cars on the road, which means more competition, less profits, a downturn for longer, also something to watch. So further, risk is another recession, but I think that these 4 billion, we can say fairly valued, so I would say, okay, that is something to put into it. If you want to check more, check my Stellantis video, that will be in the description below. Philips, they sold Ferrari, okay, they are also thinking it's overvalued like me, and then they go and buy the Philips company, a big stake, 19% from the Netherlands, healthcare, diagnosis, care, things like that, the medical technology there. I don't know, P ratio is around 20-ish, cash flows, there is some dividend. Okay, healthcare is not my cup of tea, but we'll discuss that a little bit later. We can say that fairly valued now from the Dutch market, and therefore we can add the value there. There is a lot of unlisted companies. For example, they made Christian Louboutin a billionaire when they acquired the 24% stake of that company. So, okay, that is just the valuation is based on what they paid for. I don't think if I look at these companies that the cash flows are significant towards the company. If not, you would see that cash flow. So it's all gamblers that the management is doing, and unfortunately this is also where the discount comes from, because you never know what the management is going to do with the money. They might be selling Ferrari, but that doesn't go to your account, that goes to whatever they think it is right. Let's do a valuation. 7 billion Ferrari, 3 billion CNH, 4 billion Stellantis, 4.5 billion Philips. Other listed companies, we can give it to that. That's 20 billion. What's the value? They say it's 25% of gross value. Let's give it the benefit of that and give it just 10%, especially in a crisis. And then you have here 20 plus 10%, not 25% of value, which is 4 billion minus 4 billion of debt. The real value is 20 billion of Exor. If they sell everything, pay taxes, you pay dividend taxes, that is the market's discount. So actually 0% real discount. They say they have done greatly with the business and now they sell Ferrari and buy something else. They didn't do it because the management is competent. They did it because Ferrari stock exploded. That's it. If you remove Ferrari, their return is mediocre. So I don't think that the Lingotos of Louboutins of this world will create significant value. And that is the key factor to watch with these holding companies. You never know what's the management's focus. Is it their own great job? Hanging out with Louboutin, driving Ferraris, going with choppers all around the world. After all, this is the family, the Agnelli family. So how much value will get trickled down to you is something questionable. Another questionable thing is, what's the skill of this management? Do they have the know-how, capital allocators that is required for this business? Or were they just lucky with Ferrari, which is again overvalued and they confirm it by selling it? So those are key questions to see that explain this kind of discount. Unlocking, okay, sell everything. Why can't they sell everything, double your money and everybody happy? Because you don't own the company. There is always this what if, what if, what if. Cash on your bank account is what makes you wealthier. What ifs? Not. Check my quadrant, check my research platform. I'll see you in the next video.